Good day. Greg Brown here. Today I just want to take a couple minutes and talk about investments. Investments in general. We see a lot, we hear a lot, we see it on TV, you hear a lot of people talking about it, but really, what are they? There seems to be a lot of confusion when I speak to clients as to what truly is an investment and what those options are. I'm just going to talk very high level today, and I'm going to keep it really simple. I'll start with what they're not. A lot of people think of a retirement savings plan, RRSP, is an investment. It's not. People think of a tax-free savings account or TFSA as an investment. It is not. People think of an RESP, Registered Educational Savings Plan, as an investment. It's not. All those things, an RRSP, a TFSA, or an RESP, are tax treatments of investments. A lot of people also think that a mutual fund is an investment. Again, it is not. A mutual fund is a way or a form of investing. So again, there's a lot of confusion in the marketplace. But notwithstanding what you may have seen or what you may have read about, really there are in essence three types of investments. Anything else you see or read about are some version of or a mixture of or a package of these three investments. The three investments that people can contribute their money to are, for all intents and purposes, cash, fixed income, and equities. There's a possible fourth. A lot of people think of real estate as an investment, and in some ways, real estate has some investment qualities about it, but for all intents and purposes, real estate first and foremost represents your home. It's a roof over your head. It's where you live. So I'm not really going to talk about real estate as a form of investment. So I'm just going to take a little minute to talk about the differences between cash, fixed income, and equities. You can hold all three or any portion thereof within the other accounts that I talked about in terms of mutual funds, RRSPs, tax-free savings accounts, or RESPs. But at the end of the day, you're going to either invest in cash, fixed income, or equities within those vehicles. I'm not going to talk about tax treatments today, just what those vehicles represent. So cash. Cash is exactly that. It's what you pull out of your pocket. It's what you use every day. It represents what's in your account. So it's very liquid. It's very accessible. You can write checks. You can access it through your ATM. You can access it through your debit cards. Typically, cash does not generate much of a rate of return. As a matter of fact, it probably in most cases generates no rate of return. But again, cash makes the world go round. It's what we use on a daily basis. You might maybe use cash to invest at a future point in time. So a fixed income investment is something that generates a rate of return in the form of interest. The most common forms of fixed income investments are represented by bonds. A GIC is a form of a fixed income investment. So what it is you put your money into this particular investment, and at some point in time in the future, you'll be able to get your money back. In exchange for using your money, whether that's the bank or corporation or company, they pay you what is called interest. So you put your money in and you will get a guaranteed interest rate over a period of time. Generally, they're fairly secure investments. Typically, they don't generate a large rate of return, but they're relatively safe. They're not without some volatility because of the bond market. So if I put my money in and I buy a company bond that's going to mature, i.e. I get my money back in 5 or 10 years, will fluctuate in value because interest rates go up and down over a period of time. But it's fairly safe to say if you hold it till maturity, so till it expires, you're going to get whatever the interest rate is that's on it. Now, interest is going to be taxed as taxable income. So whatever your tax rate is, that's what you're going to take your rate of return. So whether you're getting 2, 3, 4%, whatever it is, you're going to be taxed on that at whatever your tax rate is. So if that's 30% and you're generating 3%, it's going to be 3% minus 30% is going to be what your net gains are on that investment. The other form of investment is called equities. So equities are basically buying a share in a company, private companies. There are all sorts of companies all over the world, in Canada, in the United States, whatever. So you buy a share and you make money on that share in one of two ways. The company, through its profitability, it makes profits, it makes money, will pay shareholders what's called a dividend. A dividend is similar to an interest rate, but it's not interest rate. It is cash paid back to shareholders based on the profitability of that particular company. Dividends are taxed at a lower rate than interest is, so it's a better form of a rate of return. The other way that you can make money on equities is that they fluctuate in value depending on how the company is doing. If the company is doing well, the value of the company, because its profits are growing, will increase. So if you buy a share today at $10 and next year it's worth $15, you've increased the value or your rate of return by 50%. And that's what is called your capital growth, the growth of your stock. And again, capital growth, no different than the change in the value of your home, is taxed at a preferred rate or at a lower rate than interest rates are. So if you buy equities or you buy stocks, which is what equities represent, you will make money one of two ways. Either through dividends, so that's a return of a portion of the profits of the company, or through the growth in the value of the stock. Or likewise, stocks also can go down in value. So if a company is not performing well or it loses money, the value of the stock is going to go down. So unlike cash and unlike fixed income investments, equities tend to show a greater rate of volatility. So that means they fluctuate up and down. And that is the risk. So in essence, in terms of investing, you can invest in one of three things: cash, fixed income, which is bonds or GICs, or equities, which represent stock. The best thing to do is have a mixture of all three because they all perform differently at different times in the marketplace. And that is different for everybody. So I suggest that you take some time to talk to a financial advisor to find out what is best suited for what your goals and objectives are. Everybody's different depending on their stage in life and what their priorities are. So I hope I've helped clarify a little bit about what investment options are available to you and what they are and what they're not. It's just a very simplified form, and in future videos I will drill into each one in a little more detail. I'll also talk about the different tax treatments, those accounts like mutual funds, tax-free savings accounts, and RRSPs. I will also talk a little bit about things that you're going to hear in the marketplace or may have seen on the news, and hopefully try to put it in layman's terms, things that are simple to understand so that you can make an informed decision that's best suited for you. I hope you found this useful and of value. If you know of anyone who can also help by getting use of this information, feel free to share this video with them. If you have any questions, don't hesitate to give me a call. Thanks very much and have a great day.